Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Nancy Tengler, CEO and CIO of Leffer Tengler Investments and author of The Women's Guide to Successful Investing. Nancy recently launched an ETF which invests in high-quality, large-cap stocks that have strong earnings and dividend growth potential, and also an above-market dividend yield. This is a very interesting strategy developed by Nancy, which has been available to her clients, her wealth management clients and SMAs. So we are talking about the markets in general and her ETF as well as her book. There's a lot to talk about, so I'm really excited about this conversation. Nancy, welcome. Thank you for coming on the show.
Well, Nina, thank you so much. Happy to be here.
So let's start with the broader markets. Stocks have had an amazing rally this year, particularly technology stocks, the Magnificent Seven. And that is mainly because the economy has remained resilient, defying all expectations. And during the summer, stocks rose on hopes that the Fed could be nearing the end of its tightening cycle. Now, this week, they have struggled a little bit because there are concerns about inflationary pressures reemerging and about the Fed's moves later this year. So the biggest question for investors is whether this rally can keep going and can the US economy manage a soft landing? Tell us about your thoughts.
Well, thank you, Nina. I think a couple of things. We should keep in mind that despite recent weakness, the Nasdaq's up almost 32% year to date, and considerably more than that off of last October's lows. At Leffer Tengler and in the strategy that we're employing in TGLR, we actually increased our exposure to technology and consumer discretionary last fall. And our thought was, first of all, the stocks have been beaten up pretty significantly, but also in a slowing growth environment, you want to own companies that can sustain earnings growth. And technology has significant secular tailwinds behind the names. And so we took that opportunity to add to holdings. We were trimming them in the early summer and midsummer. And if they continue to sell off, we will be back in because we think that it is possible to get a softish landing. Our friend Ed Yardeni talks about a rolling recession. I think that's entirely plausible as well. And we want to own our investing theme in general is old economy companies that are employing digital solutions and the companies that are suppliers of those solutions. So think cloud, digitization, and generative AI. I don't think it's a bubble. So we will use weakness to continue, to go back in and add some more in those names if necessary. And then the last thing I'll say is we expect the market to kind of emerge from September, October with a rally into the end of the year. And the reason for that is we are seeing earnings estimates increase in the back half of this year. And the second quarter, despite the headline, was actually pretty good, down. But once you backed out energy, earnings were actually up 3.5%. So we think that investors are too pessimistic on the earnings front. And so we are finding a lot of high quality names because of the lack of breadth in the rally, a lot of high quality names in other sectors that we've been adding to.
Very interesting. And as you mentioned, that the Nasdaq has done so well this year, it's still up more than 30% year to date, despite the recent, slight of sell-off this week. And according to Barron's, this was the best 8 months of the year since 2003 for this tech-heavy index. And you think that it is the right time to add tech or on any weakness? So could you expand a little bit on that?
Yes. So if you look back historically, when we've had tight labor markets, and the most analogous period is the 1990s, tech spending not only increased, but tech stock prices rallied and outperformed the market. So we know that even recently we've seen some increase in the participation rate. We still have 8.8 million open jobs, according to the JOLTS numbers we just recently received. Much better than the 10 and 11 million we saw earlier this year, but 8.8 million nonetheless. And so when you're in that kind of environment, and we're doing it in our own company, you try to solve your productivity problems with technology. And so we would expect to see spending in the cloud, which is expected to have a total addressable market of $3 trillion by 2026, and yet only 38% penetration. We expect to see that spending continue. Add in the productive uses and the commercial uses of generative AI. And then companies like Walmart, McDonald's, Starbucks, Pepsi that are using digital solutions to drive margins, develop products, build brand loyalty. We think this theme that we are focused on will continue for years to come.
Okay, excellent. So I wanted to talk about China now, because one of the biggest concerns for investors lately is China's economic slowdown. And we know that the world's second largest economy hasn't really recovered from the impact of the strict pandemic-related lockdowns for more than 3 years, and the real estate sector is in crisis. But you think that these Chinese economic worries are slightly overdone. Could you talk a bit about that?
Yeah, so it's mostly anecdotal at this point, but I think just as the reopening was sort of overhyped for China and didn't necessarily materialize, I think some of the focus is overly pessimistic. And here's why. The basket of Chinese commodities is up 15% since May. Starbucks, company anecdotes. Starbucks reported 50% improvement in sales in China. Lululemon recently reported 61% improvement in sales quarter over quarter, year over year. And so I think what the sort of demise of the Chinese consumer is greatly exaggerated. Maybe these are just high-end consumers, and as in the U.S., you are seeing, stress at the lower income cohort, but we're seeing greater demand, and so we've been poking around. We've been looking closely at Nike, which we don't own, to maybe add a position. We do own Lulu and Starbucks, and we've been adding to Starbucks after having not done so in the previous year. So we think maybe the surprises will be to the upside, and the commodities are one of the clues that maybe this is a more broad-based, modest improvement in the economy. We don't think China returns to the halcyon days, but we do think that it's probably on a relative basis going to deliver better than expected growth and U.S. investors may be underestimating that.
Very interesting. Now, I wanted to talk about earnings yields too, because we focus on ETFs and ETF flows here. So we have seen a lot of interest in bond ETFs this year, mainly because yields are at levels not seen since the financial crisis. We have seen a lot of interest in money market funds. Hundreds of billions of dollars have gone into money market funds this year. And many investors look at stocks earnings yields, which is basically calculated by dividing a company's expected earnings over the next year by its stock price, and then compare that yield to government bonds. And that is called the equity risk premium. And that basically indicates how much investors are being compensated for taking that extra risk of owning stocks, the risky assets. And the Wall Street Journal reported recently that this extra reward has fallen to its lowest level in 20 years. So I was interested in your thoughts on earnings yields and equity risk premium. Do you consider that into account in your strategy?
we consider it in our overall allocation for our clients. But we were out of bonds in August of 2020 when the 10-year yield hit, I think, 50 basis points. We couldn't figure out how to make money from there. So we moved our clients into other asset classes. We have a clean energy strategy, convertibles, and we sought to get them income there. But then we went back in last summer, and I think we're emblematic of what you're seeing in ETF flows. We've moved clients back into bonds. But our allocation is not enormous. And I think what I've learned in looking at the research is that the earnings yield on the S&P vacillates between, historically over the last 30 years, above the earnings, the yield on the 10-year and below. And what you see during those periods is that stocks perform about the same. So for us, we look at real yields, and we're at about 2% on the 10-year. If you go back and look historically, and I just looked at the 1990s because it was such a wonderful time to be an investor, the real yield vacillated between 2% and 4.5%, and stocks did extremely well during that decade. So we think investors are going to return to the fundamentals. If these companies can continue to deliver earnings growth, then I think stocks can perform well, and you'll start to see flows move back in to equities from fixed income or from cash, because there is a tremendous amount of cash on the sidelines. And I think that is what the next round of what we'll see will take place.
Right. Yeah, that would be really bullish for equities if we see some of that cash moving back into stocks. Now, let's talk about your ETF, TGLR. Please tell us about its strategy and why you decided to launch this ETF.
Oh, I'm happy to. So I've been managing portfolios since the mid-1980s using a valuation metric called relative dividend yield. And it was developed by my partner at the time, Tony Spare, and then we honed it together over the years. And what relative yield does is we take the yield on a stock and we graph it against its own history and then compare that to the S&P 500. And that's the relative nature. It identifies very nicely fallen angel growth stocks as they're out of favor and the yield rises. They become attractive to us. The ranges are set one standard deviation away from the mean. But what's especially important is that managements set the dividend policy based on what they think is a portion of long-term sustainable earnings growth. Managements and boards are loath to cut dividends. So when you see a management team raising the dividend, and many of them actually state this in their policy that, the dividend is a portion of what we think long-term sustainable earnings growth is. And so you get great insight, probably better. In fact, not probably, actually better than you get from earnings, because analysts, estimate earnings. They're wrong 2/3 of the time to the upside and the downside. And so we're getting an estimate from management and we're getting a growing dividend. And so over the years, it has produced in our SMA accounts, upside capture in line with the benchmark, downside capture much lower than the benchmark, and results that sort of catapult us into the top 5%, 1% over the very long term of our peer group, because it leads you to better companies. We don't own any electric utilities, and we rarely own REITs. We're underweight consumer staples, so it looks different than the average equity income portfolio, and yet we are able to produce an above market yield and run it in a concentrated fashion with about 25 to 30, sometimes 35 names.
Very interesting strategy. And I'm looking at the portfolio. It currently has 33 holdings. And I see AVGO or Broadcom, Oracle, Microsoft, J&J, Home Depot. These are the top holdings currently. So could you please talk about some of the holdings that you really like?
Yes, and I will, Nina, and I'm going to give you a really quick example of how this works so
Sure.
nicely.
Please.
So in 2012, 2013, we were we became attracted to Apple. It was, if you can believe this, yielding almost 3%, and it was yielding above the 10-year at the time. We began accumulating holdings. We knew all the problems. Tim Cook was no Steve Jobs. It's only a handset company, but we were focused on services. So it came into our buy range, and then we do fundamental research. We have a proprietary model, 3 qualitative, 9 quantitative factors. And the reason that's important is it keeps us, for the most part, not always, from owning what we call terminally cheap stocks and other people call value traps. So we, then became net sellers of Apple going into 2021. We sold some more this first quarter of this year, or first half of this year. I can't remember exactly when. And it's now a much smaller position, and we are scaling our way out. We're going to wait on this latest news and take some gains, we hope, later as things sort out with Apple and China. But I think it's a great emblematic example of why relative yield leads you to great fallen angel growth stocks. So in the names that you put forward, Broadcom is our largest holding across not just TGLR, but all of our large cap equity strategies. We bought it because we think Hock Tan is an incredible operator. We've enjoyed the 50% run this year due to their exposure to AI and increasing growth in that area. I think they expect to be at 25% of revenues, and they're at like 12 right now for by 2026, I think. But we love the management team. They make smart acquisitions and they make them accretive. AI is kind of a bonus. Oracle's a name I've owned for decades on and off. The old metric used to be you'd watch when Larry Ellison came back from racing his sailboat, and you'd buy when he came back to the company. But we're actually much more sophisticated than that. We again, it was attractive on relative dividend yield. We did the fundamental work, and we decided we wanted to own it. That turns out to also be a beneficiary of low-cost AI computing on the cloud, and so that has catapulted the stock this year. We still like it here. They report on Monday. It's likely to disappoint because expectations are so high, but we still think you want to own this stock for the next 3 to 5 years. And then Microsoft. I mean, it's such an obvious name, but if you just look at every business line they're in, they're a leader. And one of our favorite names in our non-dividend paying portfolios is Palo Alto Networks, who generate, it's cybersecurity. They're best in class, we think. It's in our 12 best ideas portfolio. But Palo Alto Networks has about an $8 billion cybersecurity business. Microsoft's is $20 billion. So if you think that there's going to be pressure on CIO budgets, expect them to consolidate. And every CIO report I've read, cloud computing, Microsoft's benefiting from a shift away from Amazon and Google. Cybersecurity is another one. We're actually adding to our Microsoft suite at our firm. I think they become the beneficiary, and bad news will become good news for Microsoft.
Great. Now let's talk about your book, because we know that you're very passionate about teaching people how to save and invest. And the second edition of your book, The Women's Guide to Successful Investing, is coming out later this month. So please tell us a little bit about this book, and also talk about why women and men as well should invest in ETFs.
Yes. So we also are launching a not-for-profit educational organization because we are so passionate. But the book actually came to me when I retired from the business for about 5 years. I went back to graduate school, got a degree in creative writing, creative nonfiction. And I met a lot of women that, at sporting events with my kids. And these were women who had like MBAs, were lawyers. One was a rodeo queen. They were accomplished women in their field, and not a one of them was involved in the investing of their family wealth, not even aware of the strategy. And this really troubled me. And that's why I wrote the first edition. The second edition focuses on a lot of case studies from my wealthy clients and maybe not as wealthy clients, what I've learned, what they've taught me. good and bad, so that people can learn from their successes and mistakes. And obviously they're anonymous. But the really important factor for women to understand is, and there's a lot more research since I've written the second edition, but than the first. There was one study on the first edition that showed women made better investors than men. But there are actually a number of studies that have come out. And there's various reasons for that. But one is that we tend to do more research. We are willing to change our mind, and we don't trade as much. There's not as much competitive fire to beat a benchmark. We make our decisions and then we stick with them. And I am trying to make investing accessible to women, because the average age of the first divorce of a woman is 30 years old in the US, and the average age of a widow is 59 and a half in the United States. So both very young. You got enough problems if you find yourself in either of those situations. And so learning to invest or learning to relate to your advisor is not one you want to add to the list. 2/3 of women fire their advisor if they that was managed by their spouse. We call it the money spouse in the business.
Excellent stuff, Nancy. Congratulations on the book and on the ETF. And thank you so much for joining us today and for sharing your insights.
Thank you, Nina, very much.
That was Nancy Tengler. Let's quickly recap the stock tickers that she mentioned. She talked about AVGO or Broadcom. The ticker symbol is AVGO. Oracle, the ticker symbol is ORCL. Microsoft, everyone knows, is MSFT. She also mentioned Apple, AAPL, Starbucks, SBUX. Now, her ETF is TGLR. This is a relatively new ETF. As I mentioned, this just launched last month. It has an expense ratio of 95 basis points, and this is actively managed by Nancy, and a very interesting strategy of investing in high quality stocks that have strong earnings and dividend growth potential and an above market dividend yield. Not many ETFs with that kind of specialized strategy. There are many quality focused ETFs that look at high quality stocks trading at attractive valuations. We have talked about QUAL, and QUS and other high quality ETFs in previous episodes. Then there are some ETFs which are becoming very popular with investors over the past couple of years. These ETFs focus on high quality stocks, and then they use options to generate that juicy dividend yield. Among the popular ones are JEPI by JP Morgan, which is actually the largest actively managed ETF now. And there's one by Amplify. The ticker symbol is DIVO. This also holds a portfolio of high quality dividend oriented stocks and writes covered calls to generate that extra income. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.